Hello traders, welcome to Rubber FX, and in today's video we are going to look at mechanical market structure and liquidity. A lot of traders struggle with market structure, and the reason is this: they do not understand the concept of liquidity and how liquidity plays an important aspect in market structure. The moment you can combine these two together, you are going to improve your overall win rate. You are going to be more confident and know where price is exactly going to, and you understand the market as a whole. So in today's video, I'll be covering a lot of topics. Okay, I'll be covering the basics of market structure. I'll be covering the concept of strong high and weak low. I'll be covering trend change in form of what? A shift in market structure, or what I call a change in order flow. I'll be covering institutional order flow. I'll be covering change of character, and I'll be giving chart examples for you to be able to understand this. So without wasting much time, what is mechanical market structure? Okay, when they say the word mechanical, it's simply you applying something or doing something in stages. Okay, meaning for you to get to stage 4, you must have gotten through stage 1, stage 2, stage 3, and then you are in stage 4. So the market is more like a mechanical movement, because price move in series of what? Impulse and correction, impulse and correction, and this is a mechanical movement in price. And you as a trader, you must also be mechanical in your approach. Okay, for example, if you need to be involved in the market for a bullish move, you know that the first move is simply an impulse. You didn't get this move, so you have to wait for the second move to happen, which is the correction. And then the third thing you need to be looking for are simply areas where you'll be getting in. That makes it what? Mechanical. You must bring this into your strategy. Make your strategy a mechanical process, meaning it must contain rules, and rules will guide you in becoming what? A better trader, or in helping shape that strategy. So what a market structure is simply a market. Okay, for a bullish market structure, we have three main market structure. We have the bullish market, we have the bearish market, where there is lower lows, lower highs, lower lows, lower highs. The market keeps printing lower lows and lower highs. Okay, and then we have the third one, a form of what? Consolidation, where the market consolidates. There is no form of what? Trend in here. But take note, in a consolidation market, for example in a higher time frame, each of the move here is simply a trend in the lower time frame. Take note of that, because there are ways you can trade this consolidation as well. Okay, so now I'm going to explain in details this bullish and bearish market structure, then later I'll come into this. Okay, now for a bullish market structure, there are things that you need to put in place. Okay, there are things you need to put in place, so pay attention, stay with me, do not go anywhere. Now obviously when you come to check your chart, you must have missed some moves. Okay, and then you're thinking to yourself, how can I continue this move? For example, you want to know the trend so that you move in with the trend, because we are made to understand that the trend is your friend. So when you see an impulse leg, okay, a trend, an impulse leg, let's assume this is a higher time frame. The first thing you need to do is, did this impulse leg cause a break of structure? Okay, did this impulse leg cause a break of structure? If yes, okay, like in this case, let me start from here. A break of structure. Okay, you ask yourself this question: did this impulse leg create a break of structure? If yes, then you take note of that, meaning you must identify the swing point. The next thing is to identify what? Your swing point. Your swing point are simply the lows and the highs that was created during the structure break. Now in this case is a bullish break, so you must identify your what? Swing low and your swing high. And one way to do that is this: you look at three candle formation. Okay, just three candles formation. Then for a swing low, the middle candle must be the lowest. Okay, it could either be with body or with the wick. Either it could be just the wick, it doesn't matter. Okay, the middle candle should be the lowest. When you see this, you mark that as your what? Your swing low that created this break of structure. Okay, and how will you know that the impulse leg is over? Is when you see a swing high as well. So a swing high, you also look at what? The three candle formation. Okay, the wicks included. Okay, it could be a wick, it could be a body, whatever it is, but make sure that the middle candle is the highest. And in this case, we have what? A swing high. Why do you need to do all this? Now the reason is this: you want to identify your swing low and your swing high to know your trading range. Your trading range. Before you engage in the market, know your trading range. Okay, so you are going to identify your trading range from the swing low to the swing high. These are the first thing you need to do as a trader. Okay, this is part of this is where I explain to those in my mentorship program, and I'm simply putting this out for you because you have been with this channel for a long time and you subscribe, you enjoy this channel, and as a community I have to give back. Okay, so take this as very important. Do not go anywhere. Now from a swing low to the swing high, you identify your what? Your trading range. So in this case, I'm going to write trading range. Identify your trading range. That's the first thing. Mechanical. Your first thing you need to do is to look for a break of structure. The next thing is to do what? Let me put it up here first. So the first one is to identify a break of structure. You ask yourself, is there a break? If there is a break, then you look for the swing point. Okay, when you identify the swing points, you mark a line like this. It's an horizontal line to identify your trading range, meaning you are going to be trading within this range. Okay, and this is the range that the market has created. So the next thing you need to do is to identify your point of what? Interest. Okay, identify your point of interest, and as usual you might have different points of interest here depending, okay, on the currency pair or the asset class you're looking at. We are going to have different currency pair. It doesn't matter. Okay, the next step now will help you to eliminate some low probability point of interest. Okay, pay attention. Now in this case here, you are going to identify your point of interest, POI. Then the next thing is to know your premium and discount zones or levels. Okay, identify your premium and discount levels. Now once you know your trading range, okay, and you mark out your point of interest, these next steps, okay, this next step will help you to do what? Will help you to know which trading POI you should be involved in and which one you should discard. Now this is my fib settings. Okay, I only have 3 levels: the 0 level, the 0.5, and the 1 level. Okay, and the reason for this, the only reason why I use Fibonacci is to know my area of premium. I know a lot of people use it to to confirm their trades, to look for some optimal level. I don't do that. All I need to know is simply, is price trading in a range? And if yes, where in the zone is it trading? Is it in premium? Is it in premium, or is it in a discount zone? Pay attention, stay with me. Now, anything trading above this premium, above this 50% level, is called premium zones. And what are the usefulness of this premium zone? The premium zone simply means that price is very high. And whenever price is high, selling is the best thing to do. Okay? You short at premium zone, and when anything below the 50% level is considered discount, meaning price is cheap. And when something is cheap, you buy. So the logical thing to do is to buy at what? At discount zone. Now pay attention. The POI above this have low probability of what? Moving higher. Okay? Meaning, if you want to buy here, I'm not saying this will not work, but it has a very low probability. Okay? Most time price may even go up, come back, make it form what? As a liquidity. And that is what I'm going to teach you when you stay with me. Stay with me, because I'm going to introduce liquidity. Because in the real life, okay, market don't just go up like this, up, down, up, down. No, it creates liquidity. And I'll tell you what that is anyway in the next, once you are done with this. So now, once you identify your point of interest that is above the discount zone, okay, above the 50% level, and you are looking for a buy, you are going to discard this. Okay. Now the only reason why you'll be looking at this is if you are trading at the monthly or the weekly time frame, because any POI on this time frame has a lot of orders in there, and price might react, and it's that reaction we are talking about. But overall, I'll go back to that. Overall, we are going to discard this. If you have to pull the trigger, maybe this is your entry time frame, you want to enter this market, you delete this above, do not consider it, let price come below. Now this other one here, you can trade off this zone. Okay, why? Because it's at the 50% level, and some of this of the POI is still below, so you can trade there with what? Confirmation. Whenever you're taking a trade there, it's always with confirmation, because you want to see if price is going to react here and give you a form of what? Shift in the internal structure, or what is considered as what? Change of order flow or change of character. Stay with me. In this zone here, you can decide to engage and move the price higher. If you don't get confirmation, the price may go lower into this point of origin. Okay, there will always be a point of origin where you can take your trade, and in this case, you can take a risky trade, price tapping in with the stop loss below here, and then you move up. Now, when the price move, you repeat this whole process again. Okay, each time price break new structure, you are going to repeat all of this. Okay, then meaning you must have your trading range. You must have your trading range here. From this high, your swing point, this is the high, and this is the what? The low. Okay, and so on and so forth. When price comes back down again, okay, to any of your point of interest, and then you monitor it for a break. When that happens, your trading range will shift again. You're going to be trading from here to this place. Now this brings me back to the concept of what? Strong high and weak low. Pay attention. Now, for a bullish market, the low that led to a break of structure is called a strong low. The low that led to a break of structure is called a strong low. Okay, the reason is because it led to a break of structure, and it also grabbed liquidity. I will get to that when we look at liquidity, because it must do two things: break of structure, grabbing of liquidity. Why the low, the high that it produces, the high why the high produced by this strong low is called what? A weak high. The reason is because it's coming from a strong low, and also it always fails to break what? Structure. Now, when this price retraces down to this point, this weak high will always be your target because it is liquidity. Pay attention. This weak high is what? Liquidity. When you are buying here, the first place you should be targeting is this weak high here. The weak high here is simply liquidity, because the market now is creating what I call institutional order flow. If you don't know institutional order flow, I will keep a link in the description, or you check up in this card here to learn more on it. Now, a bullish institutional order flow. A bullish institutional order flow is a situation whereby the highs are being what? Targeted. The liquidity, the highs that provide liquidity are the target, while the lows are protected. Why are they protected? Because they are strong lows. You need to ask yourself a question: why is it that when price is coming low, it doesn't take out this low? Those are the puzzle that I unraveled after spending so many years in the forex market. It's because those lows in this form here are strong lows, because they are strong in the sense that you don't expect price to take that low. The moment price breach that low, then you might be talking about a shift in order flow or a shift in market structure. Stay with me, do not go anywhere. Now, this high provide liquidity, okay, and is a form of what? Inducement. There are some people that will, for some reason, be willing to sell from here when price return, okay, maybe for some reason, and that provides what? Liquidity, and that's what I'll be looking at here. Now, your strong low, weak high in a bullish market, okay, each time price breaks, this becomes your strong low here because it broke structure. This becomes your strong low, this becomes your what? Weak high. When price comes back down and breaks structure again, this becomes your what? Your strong low, and then this becomes your what? Weak high, and so on. So that is all for a bullish market. The same thing plays out in a bearish market. Okay, we have a move down, okay, we have a move down. So first of all, you identify what? A break, a bearish break of structure. Okay, bearish break of structure, a bearish break of structure. Now, what is the swing high that produces that swing low? Those are your trading range. Okay, you mark out your trading range. Okay, then you identify your what? POIs. Let me bring this here. You identify your what? POI, whatever POI in here. Okay, you're going to identify them. First, you identify them. Your POI can be in form of order block or supply and demand. And what I teach mostly is supply and demand. Okay, everything in trading is all about supply and demand. In fact, in market, any form of market is supply and demand. So now, in this case here, you are going to identify your what? Your premium and discount zone. In this case, you take your Fibonacci, take it from the swing high to the swing low, because you are going bearish. Eliminate any POI that is in discount. In this case, because you want to be selling, you cannot be selling at area of discount. If you do that, it has a lower probability of success rate. So your win rate will be very small, okay, because you have been trading consistently at discount zone for a sell. Whereas you need to be patient, because in market, in trading, patience is a key. You have to be patient as a trader. And if price tap into this supply zone here and then move away, it doesn't matter. Most times it's going to come back and clear it, because it's inducing people to take that trade. Most times it's going to come back and clear. I will show that in a more complex scenario. Okay, so now when price trades back above this 50%, this is where you should be looking to start selling. Obviously with confirmation, if it's too close to the 50%, then if it's at the point of origin, you can trade with a risky entry. But as a startup, you need to always wait for confirmation, and I will show you how to do that for confirmation. Now in this case here, this eye that created a break of structure is called a strong eye. Okay, this is strong eye because it led to a break of structure, and obviously it must have grabbed liquidity. Take note, two things. I did a video on strong eye and weak low. You can check up in the card there or in the description below. You will see it. And the low that it produces is always what? A strong low. A strong low is a weak low, sorry. The low that it produces is a weak low. Is a weak low. Okay, and also what makes it a weak low is because it fails to break structure. It didn't do its job. Normally a high and a low job is to continue that structural break. This did its job by breaking the low, yeah, forming a new low. Okay, and this fails to break the structure, so it makes it a weak low. And whenever you see a weak low, that will be your target. When you are entering from here, this will be your target, and that way you'll be able to hold your trade. In case you see this setup in the weekly time frame, you know that you have a lot of days to meet this target. So therefore, it's either you keep your trade for a swing trade, or you do intraday looking for bearish entry every single day until you meet up this target. So easy. Okay, it doesn't need to be a rocket science. Okay, so you must continue all this. Look for a new break here, your new strong eye, your new weak low. Okay, continue this mechanical process, okay, to know your market structure, strong eye, and then weak low, and so on. But the problem now is this: market do not just move this way. Okay, market do not just move that way. So we have to look for a better way where market moves. Okay, so this is a typical example of where the market really moves. Okay, so pay attention. And in this case, this is where we talk about liquidity. Now, liquidity are simply orders in the market, and the market move, the price move in search of what? Liquidity. So now we have this move push up. Okay, therefore creating this as what? A high, and this is the origin. Yeah, let's extend here. This is the origin here. Now in between we have different POIs, okay, that are probably responsible for all of this. We have different POIs here, and then we have the point of origin. Okay, in this case here, for a bullish market. Now market does not just come down straight with a one leg move. It moves in zigzag, creating a form of what? Liquidity in the market. And this zigzag means is simply a trend in a lower time frame. That's why you need to be careful when you're seeing a trend in 15 minutes or 5 minutes. That could be a pullback, okay, in the higher time frame, like the 1 hour. This is the 1 hour leg of structure, creating a new high here. Okay, if you notice here now, this here was in a premium zone. If I look at this here from here to here, this is what? Premium zone. And price move above, But what happened? Price came back down because it provides liquidity in the market. And this is how you know about liquidity. These are what liquidity. Okay, internal liquidity. The main range here now is from this low to this high here. This is the range. This is your trading range. Okay, so anything within this range is called internal liquidity. So as price is trading here, it provides liquidity in form of what? You can have a trend line liquidity here. You can have liquidity in form of support and resistance here. Okay, it gives you inducement to trade. It gives trader reason to get into the market. Some people might get in here thinking that this is where the low is, and then they target high, but all they see is that price continue to print lower until it gets to this point. Now that leads to your confirmation. What do you want to see to confirm that this trend is now ready for a push? And that is called a shift in order flow or a change of character. Now, a change of character is simply a switch in the internal structure. A choch, okay, is simply an internal structure change in order flow. Okay, in this case, the institutional order flow in the lower time frame has been what? Bearish, because it is taking the lows. Okay, it took out all these lows, protecting this high. So therefore, you should be continuing this, okay, up until you get to the point of origin. Now, for us to know that this market will be willing to go up is when you see a change of what? Character. Stay with me, do not go anywhere. A change of character. Yeah. Okay, and by so doing, it created a new form of minor trading range for you to take that trade from this to this point. When price comes back to probably a point of interest that was responsible for this, then this is where you should be taking your trade. And remember, this is a strong low, this is a weak high. So therefore, price will come up and target this high after clearing all this liquidity. Liquidity is the game. Okay, structure will tell you the overall picture. But the moment this low here now becomes a strong low because it took out liquidity and it broke structure. So you don't expect price to come below this before moving up. So that is where you get your entry here. You get your entry here and then price move up. Now, what constitutes a break of structure? Okay, I did a video, I'll link in the description for a break of structure, or up here in this card. Now, I have certain rules for break of structure. I need a body close. For a bullish break of structure, there must be a close above the line I'm looking for. For in this case, this is the high. If I have a body close above this, this is my break of structure. Okay, a weak close in this case here is a liquidity grab. Okay, is a liquidity grab. But when you're looking at it in form of internal market structure, okay, a wick is okay for here, is okay, okay, because it's an internal structure. Overall picture here is simply what? To buy. So therefore, even a wick challenging this high means the order flow is changing bullish. And so therefore, when price comes down, you buy. So let's look at a bearish scenario here. Same thing here. We have our origin here, price coming up, this is origin here. All of these are liquidity, okay, that should be targeted. Now, when you buy here, you start targeting all this liquidity up until you get to this point, okay, you start targeting all that liquidity. But however, you have to be careful here, because this high here, if you look at this, is a form of what? Changing order flow here. You have to be careful when price gets to this point. Okay, but this will be a teaching for another day. Maybe I will do a second series to explain this. Otherwise, this will be too long. So let's continue for a bullish, for a bearish move. Now you can see this high was later taken because it serves as what? as an inducement. Okay, it serves as an inducement. Price took it. Okay, now our trading range first is to identify your trading range from this high, and this is the low you are targeting. This is the low. So all of these are simply noise, which is liquidity, and that is the reason why price moves. So how will you be sure that price will move from here? Is when you see a change of order flow, change of character, or a shift in the internal structure of the market. So when you see this, it means up before now the lows are being protected, okay, and the highs are being taken until this low gets challenged. When you see that happening, that's something in your brain tells you that, oh, we might be expecting market to shift to bullish institutional order flow, meaning the highs will be protected and the lows will be taken. So when price comes back here, the price comes back in here, you can now decide to take that trade. And where are your targets, your liquidity zones? Now take note, liquidity zones take note, liquidity zones are your targets. Okay, you can target here, take some position out, target this is your final destination. And if you are like me and you know that this is where price is heading to, you can keep your trade open until that is taken. Then we'll talk about trade management later on. So this is how the market operates, both in a bullish market and in a bearish market. So we are going to look at trade examples. So this is Euro USD 4-hour chart. Now I'm going to start from here because the market has been bearish anyway. So this is my trading range here. If you notice, this is overall trading range. This pullback, okay, didn't pull back to a region over 50%. If you put your Fibonacci here, it did not pull back to 50% level. So even though price is heading lower from here, whenever price is coming back, always be careful here, because this will serve as inducement. I gave some signals to my mentees concerning this particular trade that this is an inducement, and there are reasons why I could spot out the inducement, but that information strictly is for my mentees. So now what happened? Price went back for a deeper pullback. Now you look at this, now you have a pullback into the area of premium for a selling opportunity. Okay, so when price came in here into your point of interest somewhere here, you can start engaging the market. Now look at this. How do you know that this market should be able to move forward? Because all before now we have bullish institutional order flow. Okay, the lows are being protected, okay, until it goes to this point here. What happened here? We have a shift in market structure, a kind of choch, okay, kind of choch here, and then price came up into this to grab liquidity. These are liquidities, okay, and all of these lows are liquidity as well, and they are your targets, because we are in a bullish institutional order flow, meaning the lows are being targeted and the highs are being protected. So therefore you can see price heading lower. In this case, price did not take this low, instead it returned up. Okay, so let's look at our fib here, from here to here. From this origin, you can see this high here. Now price got here, went lower. Most people will continue to look for a short, but this is an inducement. I also point out this is an inducement. Okay, price took it into the area of premium, grabbed some liquidity, okay, and price even further took out some form of liquidity here, which make this high a strong high. Okay, if price is coming up here in the future, I'll be betting heavily to sell from this region here. Why? Because this is a strong guy. It took out liquidity and broke structure here. Okay, all these other high did not break this structure. You can see they didn't break structure, so they need to be cleared, and this broke structure. So in this case now, we have a new leg of structure here, a new trading range. The trading range is from this high to this low. Price is already trading back in area of what? Discount, in an area of premium. And as you can see, this is a beautiful trade that I took this morning, and it's still moving. Okay, I might look for a reaction in here because price will sweep out this liquidity only with a confirmation, because the market is bearish and this is our target anyway. But then you can also counter trade against the trend only if you understand what you're doing, because I can mark here out as a form of liquidity for price to come and tap in here. But from what I'm seeing, we might continue to go bearish. So in this case here, you can see how the market structure has helped me. All of these are simply noise. They are liquidity that price needs to take. Price took out these two, okay, create a change of character here. If you look at this, this is a change of character, and that was the reason why I took that trade. Price trade back in here. I saw my confirmation in the 5 minutes, and I took that trade. Okay, and right now we have cleared this liquidity, and we should be aiming lower. So with this example, you can see how I'll be able to combine market structure, liquidity, okay, and having a mechanical process that helps me in making my decision. Because as a trader, you should have a set of rules that will guide you in making your decision as a trader. So if you want to understand more on liquidity, I'll see you in this video.